Hi, Steve Craig here. Energy prices have been under tremendous pressure this year. WTI completely erased its 28% fourth quarter advance in less than a month. To date, oil's overall value has been cut by a third and it has erased a year's worth of advance. This is classic bear market behavior. The sell-off began after a truncation where wave C failed to carry prices beyond the wave A peak. Truncations reflect an underlying weakness in the trend. They're tricky to forecast in real time, yet the subsequent reversal tends to be swift. The decline we've witnessed is a prime example. In the February issue of Global Market Perspective, we made the point that crude was oversold from a technical perspective and due for a counter-trend advance. Let's take a closer look at the rally that developed from February 10th through February 20th, and I'll show you where a little Elliott know-how can help you stay ahead of the curve. Here's an hourly chart. After first identifying 49.42 from February 10th as the orthodox low of the preceding five-wave decline, we knew from Elliott that a counter-trend advance was likely. What we didn't know at the time is which corrective pattern would unfold. The first leg, labeled Wave A, comprised 5 distinct legs, so we could start to narrow down the potential wave structures. At a minimum, we could expect a B-wave retreat and then another 5-wave advance to give the structure the 3-wave look of a zigzag, a core Elliott wave corrective pattern. Once it could be counted as complete, the most I could say was that a top of some magnitude was in place. In other words, the market still had options open to it. First and foremost, though, a decline was due. The market quickly broke the bottom end of the corrective trend channel as well as the wave below. The downward momentum added some conviction to the idea that the counter-trend advance had ended as a simple zigzag. The market then rallied back to test the bottom end of the broken trend channel, which is common, and then steadily collapsed. As always, we'll see where the waves lead, but the key point is that you didn't need to quantify and assess the impact of extraneous factors to catch a big move. Just a little Elliott know-how. And in the for what it's worth column, the general consensus among fundamental analysts is that low oil prices are good for the broader economy and thus for stocks. The converse, of course, is that high oil prices are detrimental. Now, that doesn't necessarily match reality. The major stock averages in crude oil frequently correlate in high to low price swings. Just in the past year, the two markets spent a great deal of time trending higher, a positive correlation which goes against the fundamental grain. Then the switch got flipped. As oil prices plummeted from their January peak, the stock indices extended their climb to record heights, an inverse correlation. Once stocks topped, they sank right along with crude and back to a positive correlation. The point being that regardless of correlations, it's critically important to analyze each market on its own merits.